Welcome back to this special edition of NCBA's Cattlemen to Cattlemen, as we hear from a group of industry experts on what producers can do to better manage the uncertainty in the cattle markets. Guys, I'll tell you, I can't hardly go to a meeting or pick up a publication talking about the last couple of years without somebody addressing the issue of carcass weights and the size of these carcasses. What kind of impact has that had on our industry?
I think the big thing, and Kevin talked about it in our previous one, and that has to do with supply. It's that second ingredient to the kill in the number of cattle, right? But the question I think better should be addressed is, what are we placing? Last year, you placed a calf or a lightweight animal, it lost a lot more money because you bought them high, you had a long downtrend. So the calf fed, so what you're doing is you're placing this heavier weight animal and you're going to take them to a heavier weight, finish weight, and that's going to add tonnage to the marketplace. So until the economics are there to feed a lighter weight animal, we're going to put on feed a heavier weight animal, take them bigger, put more production, and pressure prices.
Don?
I agree. Certainly we've seen the long-term trend for heavier carcass weights over the last 50 years. And if you break that down, when we get in difficult market conditions, as Larry talked about, all participants in the market are paid on pounds. So if the market cannot return what the producer needs with price, the only opportunity is to increase that productivity, generating more pounds.
But you did say we are more current than we were. Is that fair, Kevin?
Definitely is the case. As we look at carcass weights, actually carcass weights started to run below a year ago through the second half of 2016, and we talk about those three cardinal rules that we look at: profitability, the discount futures, and a good swap on feeder cattle. It typically tells the cattle producer to pull cattle forward. So we are seeing that the last few months. Weights are starting to decline. They're still historically heavy. As alluded to, we are paid on pounds, but we're also starting to see, because we've got plenty of cattle, in fact, excess cattle for capacity at certain times of the year, especially in the fourth quarter, where the packers can now put on heavier discounts for heavyweight cattle. They can be choosier. And because of those heavier discounts, we are starting to see some of the top side of those weights come down. You know, if you look at it from a long-term perspective, carcass weights increase about 5 pounds per year over the last 30 years. The next couple of years where we're at in the cattle cycle, because of large supplies number-wise, don't be surprised if carcass weights start to plateau short-term, because the leverage component, there'll be enough discounts on heavyweight cattle that it will tell the cattle feeder, let's short day them a little bit.
Yeah, that's interesting. Clint, you talk to a lot of people, help a lot of folks market their cattle, and I guess what guidance or advice would you give in positioning ourselves for 2017 in terms of these markets?
Well, I think it goes back to what we talked about before. I mean, step number one is going to be controlling your input costs to the best of your ability. And then, in my mind, it's utilizing the technologies we have and the marketing programs available to differentiate your cattle. I talk to a lot of customers, and we survive and prosper on value-added programs that differentiate the types of cattle we have. And there's different programs for that. There's quality grade cattle that fit that, and select grade cattle that fit that. There's cattle with better average daily gains that fit a program that another one might not. But you know, we've got a lot of data that comes through our Superior system that CattleFax analyzes for us. And every year can be fluid, every year can change. It's almost like it's a living, breathing part of it. But you know, there's certain years that technology such as implanting pays very heavy. You know, there's certain years that the natural programs will give greater returns for our cattle. Export verification programs, just depending on what's going on. And the hard part about that is every program every year is going to have to be analyzed by every producer, and you don't necessarily change your entire management scheme on a ranch on a one-year basis, but you've got to be able to be fluid enough to be able to take advantage of those when they come. And that's where producers are going to have to stay engaged. And then, in my opinion, in a level to downtrending market, a cattle feeder, our buyer, wants the least amount of risk. That's better health and better genetics, and there's no substitute for that.
Yeah, it's a good point. Yeah, go ahead, Kim.
I'll just tag in on the last two comments. We do a cow-calf survey, and every year it comes back the same. There's 3 areas where the high-return cow-calf producer spends more money in, and those are areas that pay them dividends. It's genetics, it's herd health, and nutrition, just as you pointed out. That's where $1 spent might be $2 reaped. And so those are some I think are tagging in with that. I think those are some good thoughts.
That's a great point. So let's talk about input. You mentioned feed. What do you sense in terms of the overall trend in 2017 in terms of input costs? Don, you want to take a crack at the bat?
It's been an interesting year in the feed grain front so far. We had the all-time record large corn crop of 15 billion bushels. We're going to end the year with ending stocks of better than 2 billion, something over. So on total supply, we're very comfortable. At the same time, corn futures have been trading virtually unchanged or very close to year-ago levels with that huge supply on hand. A lot of that variation in the market has come from really severe pressure on cash corn basis levels. What that tells us is we're still seeing a good underlying global demand for feed grains. That probably, and that combined with the basis signals, we're not encouraging producers to have an overly aggressive corn or feed position on hand, but we would like to have some feed position on hand with the opportunity to build if market starts to rally.
Yeah, and what's this I hear about the soybean market, though, really taking some corn acres out of production potentially? Is that fair?
That's very fair. You know, our Rabo estimates are that we will likely see 2 million acre reduction in corn acres this year. There are other firms that are talking as much as a 4 million acre reduction in corn acres. That's the 2 million might be conservative today given the corn bean price spread. 4 might be a little extreme, but certainly the market's sending very strong signals to pull some of those corn acres into beans. The market with $10, $11 futures, the market's also been giving producers a strong signal. You better be selling some of these beans at these prices.
Yeah, fair enough.
I was going to just add one other thing to the comments about input costs. From a feedlot standpoint, the corn is one of our inputs that we start with. But Kevin had addressed that the discount futures will help bring cattle forward, but it also affects what they're going to pay for feeder cattle. And the reason is because the cattle feeding crush, we're going to be a lot more sensitive to it now. And if I can't buy an animal like we've had the last couple of years and lock in a break even or some kind of profit, feeder prices are going to have to come down. So when we talk about input costs, those discount futures that have a good side to it also have a limiting factor with respect to input costs of feeder cattle.
Well, certainly all the economists are suggesting that we're moving from a time in the cow-calf sector of some record profits to really the first year of some projected losses for cow-calf producers. Clint, what suggestions do you have either from a cost standpoint or from a premium and value standpoint that can help at least mitigate some of that loss or maybe put us into the black?
Well, I think every producer is going to have to sit down and analyze their own program. But they've got to start, my advice would be start with eliminating the costs that are the most egregious that you can identify right off the top, whether that's management practices we do or not investing money where we need to. You know, my grandpa used to say, if you invest in rust, it'll fade. So invest in what doesn't, like Kevin was saying earlier, you know, that way we can utilize those services that are going to best return the dollar to us, or at least they're going to lock in the most amount of risk for the buyers buying our cattle and keep us current in the market regardless of where that goes. Because a cow-calf producer can't manipulate the market with this product. He's just got to try to be as competitive as he can each given year.
You know, we went through a time when it didn't seem like there was much benefit of getting external helpers to assist us in risk management, because in fact the cattle cycle seemed to be broken and all the projections were out the window. What is your sense or your recommendation about the value of services that can help us manage volatility and risk? Don?
Given that I was in the subscription business for a lot of years, but I'm not today.
Okay.
I think it provides very valuable input to producers that as producers spend their day with management decisions and fixing fence and employ all the issues you deal with, a hired consultant, they're totally focused on the market and have a background to address it. The one last point that I would make on that, when looking for a consulting service, I think a lot of people get a name from the banker or from a friend and just say, hey, I need to subscribe to your services. the personality profile and the risk profile of the risk management manager will ultimately align with the customer. Interview, get 6 or 7 names, interview several people. There's somebody out there that you will be comfortable with, and you can take advantage of it.
And, Larry?
You mentioned something about that at Cattlemen.com. My daughter's a psychologist, and so what she's done is we have a profile section on our website to determine what kind of personality you have. Are you a lion? And give you this personality so you can work with them. And at Cattlemen.com, our focus is on managing risk. And within that, I think whether it's us or anybody else, you've got to find somebody that has what we call strategies. And on that, you've got to have somebody that has discipline. My biggest challenge as a broker, that I've been doing this for 43 years now, is lack of discipline. They're traders that are by nature, they're traders in cattle. So when they get to futures, they tend to want to do that same kind of thing, and they shouldn't really be doing that. They need to identify the risks. We look at 3 of them: profitability, price risk or opportunity, and basis risk or opportunity. We focus on those, and if we don't have a triggered from that response, you don't do a thing. And then the bottom line is discipline. At Cattlemen.com, we have a product called hedge positions. So the feedlots upload their cattle into hedge positions. This allows us to now be this consultant that Don was talking about, where we can see their cattle, how many they have coming out, what are their break evens, what percent hedge should we be, and start following these disciplines that I think are lacking in the cattle feeding industry.
Kevin, anything to add?
Well, at CattleFax, of course, obviously we've been doing this for almost 50 years, and what I would suggest from our perspective is, CattleFax.com. We have a new interactive website that's going. We also have an app that can be downloaded, and that app is free to all cattlemen, and so that keeps you abreast of the market. One thing just to ask yourself, if you're a producer, you're spending your time producing a product. If you're a cow-calf producer every day of the year, how long are you thinking about the marketing aspect? And a lot of times that marketing is taking the cattle to town the same Thursday in October, or putting them on the sale at the same time every year. There's a lot more, the seasonality, the longer term cycle. There's a lot of things that I think we, or anybody that's providing market analysis and risk analysis, can provide for that producer.
Great comments. Thank you guys so much.